A crowded Adidas store can generate hundreds of thousands of dollars in sales and still leave its operator with surprisingly little profit. The store may have a globally recognized name above the entrance. It may sell premium footwear, apparel, and accessories. Customers may line up for popular releases, but the Adidas logo does not pay the rent. The economics of the store depend on what happens after customers enter, how many make a purchase, how much they spend, whether products sell at full price, and how much inventory remains when the season ends. So, what does it really cost to operate an Adidas retail store? And how much could the owner actually keep? First, we need to clarify what owning an Adidas store means. The operator does not own Adidas or control the brand. Adidas also operates many stores directly, while other locations may be run through franchise, licensing, distribution, or commercial partner arrangements. The exact structure varies by country and agreement. There is no single publicly available franchise fee schedule or profit margin that applies to every independently operated Adidas store. This means our financial example will be illustrative, not a claim about the earnings of any particular Adidas location. What the operator owns is the local retail business. That business may employ the staff, lease the space, purchase or manage inventory, and absorb many of the operating risks. In exchange, it gains the ability to sell products carrying one of the most recognizable names in sportswear, and that recognition has real value. Customers already understand the products. The brand attracts foot traffic, supports premium pricing, and reduces the need to explain what the store sells. But brand recognition does not eliminate retail risk. Before the first customer enters, the operator may need to fund a lease deposit. Several months of advance rent, construction, lighting, flooring, shelving, signage, security systems, and point-of-sale equipment. A prominent shopping center location can require an expensive branded fit-out. The store must look consistent with Adidas standards, which may limit the operator's ability to reduce construction costs. Then comes opening inventory. A sportswear store does not simply need a few popular shoes. It needs footwear, apparel, and accessories across different models, colors, and sizes. A single shoe design might require numerous size variations. If the store lacks the size a customer wants, the sale can disappear, even while thousands of dollars in other sizes remain on the shelves. The operator may also need to fund recruitment, staff training, launch marketing, professional fees, and a working capital reserve. Depending on the store's size, market, lease, and commercial agreement, the total opening investment could be substantial. But because Adidas does not publish one universal store development package, any investment estimate must be evaluated locally. Once the store opens, its revenue engine is relatively simple. Foot traffic multiplied by the conversion rate produces the number of transactions. The number of transactions multiplied by the average transaction value produces store revenue. Imagine that 15,000 people enter the store during 1 month. If 20% make a purchase, the store completes 3,000 transactions. At an average transaction value of $80, monthly sales reach $240,000. Improving any part of this equation can increase revenue. A better location can produce more foot traffic. Stronger merchandising can improve conversion. Staff recommendations can add apparel or accessories to a footwear purchase, increasing the average basket. But the sales figure at the top of the report is not the owner's income. The first major deduction is the cost of the products sold. At the corporate level, Adidas reported a gross margin of 51.6% in 2025, but that is a company-wide figure covering Adidas's complete business model. it is not the guaranteed product margin of an independent store. A local operator's margin depends on purchasing terms, freight, taxes, product mix, returns, discounts, and its specific agreement with Adidas. Most importantly, the margin depends on whether inventory sells at full price. Suppose a store receives a new footwear collection. The most popular models and sizes may sell immediately, but slower colors and less common sizes remain. As new products arrive, the old inventory begins consuming valuable shelf and storage space. Eventually, the store may have to discount it. A product that looked highly profitable at its original price can become far less attractive after a 20, 30, or 40% markdown. This is why inventory is the center of the store's economics. Too little inventory creates empty shelves and lost sales. Too much inventory traps cash and creates markdown risk. The operator must have the correct products, in the correct sizes, at the correct location, during the correct selling period. Inventory turnover measures how efficiently the store converts merchandise back into cash. Fast turnover allows the same capital to be reused several times during the year. Slow turnover leaves the operator funding products that may become less valuable with every passing month. Adidas itself emphasizes replenishment, sell-through monitoring, and smaller initial orders as tools for reducing inventory risk. But even a strong gross margin must still support the physical store. Consider an illustrative Adidas location producing $250,000 in monthly net sales. Assume the product cost, after accounting for the store's actual product mix and markdowns, equals $137,500. That leaves $112,500 in gross profit, a gross margin of 45%. At first, that sounds excellent. But now, the store must pay $28,000 for rent and occupancy. Payroll consumes another $38,000. Card processing fees remove approximately $6,250. Freight and local logistics require $5,000. Utilities cost $4,000. Local marketing requires another $4,000. Shrinkage from theft, damage, and inventory errors costs approximately $3,750. Insurance, software, and professional expenses consume $4,000. Cleaning, maintenance, and repairs require another $3,500. Finally, assume applicable commercial or brand-related fees at $6,000. Although the actual amount would depend entirely on the operator's agreement. After these expenses, only around $10,000 remains. The store produced $250,000 in monthly sales, but its operating contribution is approximately 4%. And even that is not necessarily the owner's final profit. Depreciation, loan interest, taxes, future renovation costs, and inventory financing may still need to be paid. The operator should also reserve money for replacing fixtures, security equipment, and point-of-sale technology. If the owner manages the store personally, part of the remaining income represents compensation for a job, not a return on invested capital. Only the cash left after paying a reasonable management salary and funding the store's future represents the true return from ownership. This narrow margin creates operating leverage. Many expenses, particularly rent and core payroll, do not fall immediately when sales weaken. Using our example, the store may need approximately $223,000 in monthly sales just to cover its operating costs. At $250,000, the location is only about $27,000 above break-even. Now imagine that customer traffic declines by 10%. If conversion and average transaction value remain unchanged, monthly revenue could fall from $250,000 to $225,000. The store has lost $25,000 in revenue. Some product and transaction costs decline with the sales, but rent, management salaries, utilities, and many staffing requirements remain. A business that previously generated around $10,000 in operating profit could move close to break even. A relatively modest reduction in sales can erase nearly all the profit. Discounting can produce the same effect. A promotion may increase the number of transactions, but if customers shift from full-price products to marked-down inventory, sales volume can rise while gross margin weakens. The store appears busier. More products leave the shelves. Yet the owner may retain less money from each sale. Location introduces another tension. Premium shopping centers produce foot traffic, visibility, and credibility, but they also demand higher rent, service charges, longer leases, and costly store standards. A less expensive location reduces occupancy costs, but may not generate enough customer traffic. The operator is effectively purchasing access to potential customers through rent. The location creates value only if the resulting sales exceed the additional occupancy cost. Then there is competition from e-commerce. Customers can inspect a product in the store, compare prices on a phone, and complete the purchase somewhere else. Adidas's own digital channels may provide broader product availability than one physical location. Online retailers and competing sportswear brands create additional pressure. The physical store must therefore offer something beyond a shelf of products. It can provide immediate availability, fitting, product guidance, personal service, local community events, and the experience of discovering new releases in person. Customer data and loyalty programs can also support repeat purchases. But repeat traffic still depends on product availability and service quality. Shrinkage presents another hidden risk. Footwear and apparel are portable, valuable, and often easy to resell. Theft, damaged merchandise, transaction errors, and inaccurate stock records can steadily reduce profit. A shrinkage rate of only 1.5% on $250,000 in sales represents $3,750 per month. That's more than 1/3 of the operating profit in our illustrative model. The commercial agreement creates another layer of risk. The operator must understand who controls product ordering, pricing, promotions, store design, territory, online competition, returns, and unsold inventory. Who absorbs the loss when a product fails to sell? Can the operator transfer inventory to another location? Is the operator required to participate in promotions? Who pays for renovations when brand standards change? What happens when the agreement ends, but the store still has a long lease? These questions can matter more than the headline franchise or licensing fee. A strong operator therefore watches more than total sales. Adidas reported €24.811 billion in total net sales in 2025, with 60% coming through wholesale and 40% through direct-to-consumer channels. So, what is the economics of owning an Adidas retail store? It's not the famous logo can create traffic and trust. It is the operator's ability to consistently sell the right product, in the right size, at the right price.